Guest of the hour, great to see you, Rebecca Teltscher, Portfolio Manager at Newhaven Asset Management. Thanks so much for joining us.
Thanks for having me.
Talk briefly about FedEx. It keeps disappointing investors, it appears.
Yeah, it's not surprising. I mean, UPS had similar disappointing numbers when they reported, a couple of weeks ago, and it's an overall sign that the markets, the economy is weakening. I mean, we've seen signs of a weakening economy throughout 2024, and that was even before any of any tariffs were under threat, or so now we're having the same slowing economy, and now you have the threat of tariffs coming into play, and so I think it's really causing a disruption over here.
Nike, a renowned U.S. brand, just can't seem to get it right lately.
So, I mean, Nike, again, any kind of discretionary, consumer discretionary name under pressure, as the economy slows, as, unemployment ticks up, you're going to see a slowdown on discretionary spending, which is why, we focus on more on needs versus wants in terms of spending. But, Nike in particular, they've had a few specific issues with some of their products, with some of their omni-channels. I think they were focusing on selling directly through their own website and stores, focusing less on third-party retailers like Designer Shoe Warehouse, and they realized that they actually depend on those third parties. So there's a specific issue, but there's also, again, weakening economy and tariffs that are all coming into play right now. So, anything in the discretionary space, we saw it with Delta Airlines, we saw it even with Walmart, and Target, there is a clear sign that, consumer spending is getting weaker. The consumer is worried, is nervous, and that's going to bode very negative for a lot of the consumer and retail stocks.
One group you like are the utilities, because we've seen the likes of Emera and Fortis, two stocks that you favor. They're up sharply this year, both more than 5%.
Yeah, I mean, almost 10% for Fortis and Emera. And, it's interesting, utilities have always been our largest sector weightings, throughout anywhere in the economic cycle. We just feel like they have a lot of growth. They're going through transformational growth with the electrification of the grid, and as power demand surges, especially with new technological demands with AI chips. But now we're also seeing the other reason we like utilities is the stability of their earnings. So first, they're tariff resistant. I mean, Emera and Fortis both have more operations in the U.S. than they do in Canada, but there's no cross-border trade, and there's no threat of tariffs, right? So they're rate regulated in the jurisdiction that they operate in. So there's no threat of tariffs or anything like that. But they also have very defensive characteristics. So if you think in a recession, are people going to stop buying a brand new pair of Nike shoes? Probably. But are they going to stop, running their dishwasher and turning off their lights? No. So you just see like that consistency of their earnings, and in a time like this when the market gets scared of a recession, you see how well these utilities actually perform, and we're seeing that flow of funds away from riskier stocks that have been chasing growth for the past 2 years and into more defensive and stable stocks like the utilities. So despite all the economic weakness and weakness in the markets, like our portfolio has been up year to date.
I'm looking, over the past year, sure, the TSX Utilities Index is up about a total return 21%, whereas the TSX has had a total return of 17%, obviously including dividends. However, over 5 years, I am showing that the Utilities Index, and of course that includes a whole bunch of different companies, has lagged the TSX. So you do give up some growth with utility stocks.
Absolutely. And we make that very clear to our clients that, especially if you look at the last 2 years, 2023, 2024, markets were on a tear. They were really, they were searching for growth, they were searching for risk, and that's just not the area we were playing in. We didn't own any of the Magnificent Seven, we didn't own any of the technology stocks, but we're okay with that because at the end of the day, you get that consistency of earnings, and in times where markets are down or negative, you really get that resilience, and clients feel comforted in times like this where the headlines are all negative that their portfolios are actually doing okay. And not only that, the dividend income that is being generated in the portfolio is still growing and is still consistent. So that's also very important that we're looking at. So in the technology space, you're not really getting that much dividend yield. So if you're retired living off of the income in your portfolio, and the market's down 10%, then all of a sudden that's your worth just went down. But if you're focusing just on the income, that's still up year to date.
Just finally, leave us with a final thought. We are apparently going to get this election call on Sunday. What do you think investors want to see in this federal election campaign?
I think a lot of investors want to see some change, but I think more importantly, I think they want to see a leader that's going to put Canada first and be business friendly. I think we've seen some policies in the past, decade that have maybe not been so friendly to investors, particularly in, the oil pipeline space. I kind of think to myself, what would have happened 10 years ago if Energy East, which would have been, TransCanada or TC Energy's pipeline to bring oil from, west through to, Quebec and out to the East Coast, like if that would have been built, we would have been less reliant on bringing, on our energy going just to the United States, and we would have had export capability beyond the United States. So I think, the threat of tariffs is definitely putting into focus that the next leader of Canada needs to put Canada first and put in policies that are friendly for business and investors.